What does it really take for a major financial institution to, well, not to survive, but actually thrive in today's economy? It's pretty dynamic out there. That's the big question we're exploring today. We're going to unpack the financial performance of the Central Bank of India. This is for their first quarter, the one that ended June 30, 2025. So Q1 FY26. Our mission, really, with this deep dive is to pull out the most important bits, those nuggets of knowledge from their latest press release, their financial presentation, and the notes from their board meeting. We want to give you a clear, concise understanding of the bank's health and where it's headed strategically. And what's kind of interesting right on the bat is they reported really strong net profit growth. But, and this is the catch, there's actually a bit of degrowth in a key income stream. So that hints at some strategic shifts maybe.
Okay, let's unpack this financial deep dive into Central Bank of India. We've got some really interesting numbers and strategic moves to explore for their first quarter of fiscal year 2025-26.
Absolutely. And before we dive right into the bank specifics, I think it's really crucial to get a feel for the economic backdrop because India, as a whole, it continues to stand out, really, a bright spot in the global economy. You've got strong services, agriculture's looking decent, positive monsoon forecasts, which always helps, and robust GST collections, too. All that provides a pretty resilient foundation for the banking sector.
That does set a promising stage. So, okay, before we zoom right in on Central Bank of India, what's the broader economic picture look like?
Yeah.
Globally and within India?
Well, globally, things are moderate, you could say. Moderate growth, but still dealing with, persistent trade frictions, quite a bit of policy uncertainty, and consumer confidence isn't exactly soaring. But India, it really does stand apart. I mean, the economy's tripled in size since 2014 and 15. That's quite something. Now, real economic growth, it's expected to moderate just a touch in Q1 FY26 compared to the 7.4% we saw back in the March quarter, Q4 FY25. That's the RBI MPC projection. But the inflation trends, those are looking very positive. Retail inflation, it moderated down to 2.1% in June 2025. That's actually the lowest since January 2019. And wholesale inflation, it even dipped back into negative territory, first time in 2025. So the expectation is inflation will stay pretty muted, likely below the RBI's forecast of 3.7% for the whole fiscal year FY26. Oh, and just a quick note for you listening, when we say lakh, that's 100,000 and a crore is 10 million. So 100 lakh rupees is 1 crore rupees, just so the numbers make sense.
Right, good clarification. So that sounds like a remarkably supportive environment for banks to be operating in, doesn't it? What's the general health of the banking sector in India right now, given those broader trends?
Yeah, generally healthy. According to the RBI's own financial stability report, banks are seeing improved profitability. And that's mostly driven by increased net interest income generally, pretty healthy credit growth, and crucially, lower provisioning needs. Banks aren't having to set aside as much for bad loans. The sector overall shows adequate capital, good quality common equity tier 1 or CET1 capital. Bad loans are declining and credit costs are lower. And what's fascinating here, I think, is how that bigger economic picture really feeds into individual bank performance. Like take the repo rate. It recently declined from 6.5% to 5.5%. Now, that's expected to significantly turn around credit growth, probably starting from the September quarter. And that's a key indicator for banks like Central Bank of India.
Okay, so the broad Indian economy is definitely a tailwind. That makes sense. But for a bank like Central Bank of India, with its long history and its public sector background, do these trends hit them differently, maybe, than a private bank? How's it positioned within this landscape, give it its own sort of identity?
That's a great question. Central Bank of India definitely comes into this with some, let's say, inherent strengths, partly from that long history and its public sector status. It's got a strong brand image. I mean, the legacy of over 113 years, that counts for something, and its reach is huge. As of June 30th this year, over 21,000 customer touchpoints across India. That includes 4,552 branches, over 4,100 ATMs, and a really big network, over 12,000 of these business correspondent points. Those are the agents extending banking into more remote areas. And notably, a huge chunk of his branches, like 65.22%, almost two-thirds, are in rural and semi-urban areas. It's nearly 3,000 branches. Plus, they have a dedicated staff of over 33,000 people serving, get this, an active customer base of over 8 crore. That's 80 million people.
Wow, that's a massive footprint. That deep rooting, especially in rural and semi-urban India, that sounds absolutely vital. Now, a key part of any bank's foundation is its deposit base, right? How's theirs looking? Stable? diversified.
Yeah, their deposit base is definitely a strong point. They've maintained a really robust CASA base. That's current account savings account. It stands at 46.88% of their total deposits. And having a strong CASA base like that, well, that's a huge strength for any bank. It means a stable, lower cost source of funds, which, directly helps profitability. And speaking of profitability, that brings us right to the headline figures for this quarter. Let's maybe dig into what those numbers are actually telling us.
Okay, let's do it. Those headline figures for Q1 FY26 versus the same quarter last year, Q1 FY25. Overall business grew by a pretty solid 10.84%. That takes it up to 704,485 crore rupees. That's over 70 trillion rupees. Huge number. Breaking that down a bit, total deposits, they increased by 11.41% to 428,890 crore. And gross advances, loans basically, they rose by 9.97% to 275,595 crore. Now, profitability, this is where it gets interesting. Net profits surge, a really remarkable 32.84% jump up to 169 crore from 880 crore last year. Operating profit also up by 15.60% to 2,304 crore. And the bank saw really impressive improvements in its efficiency metrics too. Return on assets, ROA, climbed 20 basis points. That's 0.2 of a percentage point. Takes it to 1.02%. And crucially, that crosses the 1% milestone, which is kind of a benchmark in the industry, right? Shows efficient asset use, sustainable profit. The return on equity, ROE, also improved significantly, up 157 basis points to 14.17%. And maybe even more critical, asset quality. Big improvements there. Gross non-performing assets, NPAs, bad loans basically, improved by 141 basis points, down to 3.13% from 4.54%.
And net NPA, that's after provisions, stood at just 0.49%, down from 0.73%. That's a 24 basis point improvement. And importantly, it drops below that 0.5% mark, 0.50%. That's a really key achievement, isn't it? It signals they've basically covered almost all their problem loans, strengthens the balance sheet, cuts future risk, and the provision coverage ratio reflects that, improves to 97.02% from 96.17%, a really strong buffer. Finally, efficiency looks better too. The cost-to-income ratio improved down to 55.43% from 57.71%. And capital adequacy remains strong. The CRAR, capital to risk-weighted assets ratio, improved to 17.66%. Tier A capitals at 15.48%. So yeah, clearly some very strong numbers overall, especially that big jump in net profit and much better asset quality. But looking closer, I do notice, as we hinted earlier, the net interest income, the NII, actually saw a bit of degrowth. Can you help us understand that? Seems a bit contradictory.
That's a really sharp observation. And yeah, it definitely raises an important question. So while net interest income, NII, which is, the core income from lending, it did see that slight dip, 4.65% down. It came in at 3,383 crore compared to 3,548 crore last year. However, the overall total income, that's interest income plus non-interest income, that actually improved by 9.20%. It reached 10,374 crore, up from 9,500 crore. So what does that tell us? It tells us there were other pretty powerful drivers at play this quarter, specifically non-interest income. That saw a very strong increase, up 53.30% to 1,786 crore. Now, what's in that? Well, a big chunk was profit on the sale of investments. That was 577 crore this quarter compared to just 104 crore in Q1 last year. And also really strong recoveries from accounts that had previously been written off. That contributed another 61,276 lakhs, so over 612 crore.
Oh, okay. So it was really a story of diversification then. And some pretty sharp asset management boosting the bottom line. That's a great moment, I think, for you listening. Shows that even if one core area like NII dips a bit, other strategic areas can more than pick up the slack. Okay, so digging deeper into the loan book then, if corporate lending was down slightly, where did the actual loan growth come from?
Right, the growth driver was definitely the RAM segment. That's RAM, retail agriculture, and MSME, micro, small and medium enterprises. That whole RAM business expanded by 15.71%, took it to 198,629 crores. Breaking it down, retail loans grew 17.51%, agriculture was up 12.70%, and MSME loans grew 15.94%. And that's in contrast, as you said, to the corporate loan book, which saw a degrowth of about 2.52%. The bank also comfortably surpassed its mandated targets for priority sector lending. Like agriculture advances were at 20.95% of lending against a government norm of 18%, and total priority sector advances hit 53.86%, way above the norm of 40%. So if you connect this back to the bigger picture, that strong focus on RAM, it really signals a strategic shift, doesn't it? Moving maybe away from potentially riskier, chunkier corporate loans and more towards granular, probably more stable growth, which aligns with broader trends in India. And their deposit mix supports that stability too. Savings deposits are almost 45%, 44.71%, and quota deposits make up just over half, 50.68%.
The RAND focus is clear. It's interesting, though, looking at the NPAs within those sectors, retail and corporate, they seem to have relatively low NPAs compared to agriculture and SME, right? Retail gross NPAs is 1.08%. Net NPA is tiny at 0.07%. Corporate gross NPA 1.65%. Net NPA almost zero at 0.03%. But then you look at agriculture, gross NPA 6.32%, net NPA 1.67%, and MSME, gross NPA 5.13%, net NPA 0.66%. So what specific measures is the bank taking to keep asset quality in check, especially in those slightly higher NPA sectors like ag and MSME?
Well, first off, as we mentioned, they've maintained that really high provision coverage ratio, 97.02%. So that's a strong buffer right there against potential losses. But proactively, they're also leveraging technology. They're using a digital lending platform for loan origination, which helps with initial screening. And for collections, they've set up dedicated call centers. But importantly, these have feet-on-street functionality. That means they have actual staff on the ground following up on at-risk accounts. It's not just calls. It shows pretty proactive asset management. They're even using things like IVR, interactive voice response, and BOT calling, automated robotic calls for better outreach. So it's a real multi-pronged approach, blending tech and human touch for recoveries.
Okay, that makes sense. And what about their broader digital strategy and their commitment to financial inclusion across India? That seems core to their identity, too.
Absolutely. Their share of digital transactions done through alternative channels like mobile or internet banking, it increased significantly, up to 85.23% from about 81.83% year on year. That's a clear shift in customer behavior or maybe bank strategy driving it. And UPI, Unified Payments Interface, transactions saw really remarkable growth, up 34.6%, huge jump. Their digital initiatives are pretty comprehensive. There's that digital lending platform, or DLP, which handles various loans, pre-approved personal loans, gold, home, vehicle, mudra loans for small businesses, and so on. They also have a unified complaint management system, a lead management system to track potential customers. And this is quite innovative. They actually inaugurated an AI-based automated pawn machine for gold loan disbursement. That's a really pioneering initiative, I think. Shows they're pushing the boundaries a bit, beyond just standard digital banking. And yes, financial inclusion is key. They actively participate in all the major government schemes, PMJDY for basic bank accounts, PMSBY, and PMJJBY for insurance, APY for pensions. Their PMJDY accounts alone are nearing 190 lakh. That's 19 million basic accounts opened.
Yeah, that AI gold loan machine sounds fascinating. And it's genuinely encouraging to see a big institution like this actively embracing ESG too. Environment, social, and governance. It feels like it's becoming less of a nice to have and more core, right? It's not just about the numbers anymore. It's about their impact on the community and environment.
Precisely. And they seem quite structured about it. They have an ESG governance structure in place which ensures accountability and strategic coherence. They're even computing finance emissions. That's the emissions linked to their loan book for MSME, corporate, housing, and VICA loan portfolios. That's part of their Scope 3 Category 15 reporting. Shows real detail. They launched a specific product, the Cent Solar Scheme, to finance solar assets in agriculture. And they mobilized over 92 crore rupees from green deposits just in this quarter, Q1 FY26, specifically to support environmentally friendly projects, renewable energy, green buildings, smart agriculture, water management, things like that. They're also supporting the government's PMQM scheme, financing solar power plants to the tune of about 138 crore. And beyond the environmental stuff, they've actually been recognized with awards recently for enterprise security and innovation, which kind of underlines their commitment to being a robust modern bank. Oh, and one other thing, on new ventures, they strategically acquired significant stakes into insurance businesses from the Generali Group. These became effective June 5th this year. They took about 25% in Future Generali India Life Insurance and just under 25% in Future Generali India Insurance, the general insurance arm. So that expands their financial services offerings quite a bit.
Okay, lots happening on the strategic front. Now let's turn to the auditor's view. Always important. The bank's board approved both the standalone and the consolidated financials on July 19th, 2025. And what's really crucial here is that the independent auditors give an unmodified opinion, which basically means, in plain English, that the financial statements are presented fairly. No major red flags from the auditors. The board also declared an interim dividend for this fiscal year, FY25-26. It's 2%, which works out to 20 pays, or 0.2 per share. But the auditors did highlight a few specific points under what's called emphasis of matter. And these are often really important for understanding the full financial picture, aren't they? Like, for instance, that change in depreciation method you mentioned earlier.
Yes, exactly. That's a really important nuance to grasp. So effective April 1st, 2025, the start of this fiscal year, the bank shifted how it calculates depreciation on its fixed assets. They moved from the written down value, or WDV method, to the straight line method, SLM. Now, the immediate impact of that change for this quarter was actually an increase in the depreciation charge. And because depreciation is an expense, that resulted in a decrease in the reported net profit by about 5,763 lakh rupees for the quarter. Now, you might ask, why would a bank make a change that lowers its current reported profit? Well, often it's done to better reflect how an asset's value is used up over its useful life, or sometimes to align with common industry practices. It can provide a more standardized view over the long run, even if it hits the current quarter's profit figure. So understanding these accounting nuances is really key to getting the complete picture beyond just the headline profit number.
Right, that makes sense. It's not operational performance, but an accounting choice impacting the number. Good reminder. And there was also an exceptional income item, something related to bank amalgamations.
Correct. If you look at the consolidated results, there's an exceptional income item listed about 8,485 lakh rupees. This comes from the difference between what central bank carried its investment value at for two regional rural banks, Uttar Bihar Gramin Bank and Uttar Banga Kshatriya Gramin Bank, and the actual cash or value they received when these RRBs were amalgamated with other banks. That amalgamation became effective May 1st, 2025. So it's basically a one-time gain resulting from that restructuring event, not part of regular operations. Also noted by the auditors were the deferred tax assets DTAs. The net DTA recognized on the balance sheet as of June 30th was around 253,138 lakh standalone, slightly less consolidated. This was actually a reduction from the previous year. The auditors also noted the bank's decision to continue providing for minimum alternative tax or MIA-MAT, even though they had a favorable ruling from the Income Tax Appellate Tribunal. They cited prudence, which again, I think highlights this pattern we're seeing of financial prudence. The bank seems to be opting for a more conservative accounting approach, maybe to bolster long-term stability, even if it slightly dampens current reported figures.
Yeah, that level of transparency and conservative accounting, it usually sits well with investors, doesn't it? What about fraud reporting for the quarter? Any major issues there?
Encouragingly, no. The bank reported just 33 instances of fraud in Q1 FY26. Now, that might sound like a lot, but it's actually significantly down from 562 frauds reported in the same quarter last year, Q1 FY24. So a massive improvement. The amount involved in these 33 frauds was about 967 lakh rupees, and the bank confirmed that full provision has already been made for these amounts. So the financial impact is essentially covered.
Okay, good. And their portfolio management?
Yeah.
Anything noteworthy on, say, co-lending or loan transfers?
Yeah, they seem quite active there. The bank acquired a fair number of standard performing assets through co-lending arrangements or innovation. That is over 40,000 accounts with about 181,777 lakh rupees outstanding. They also did some pool buyouts, acquiring portfolios of loans. That added another 23,500 accounts worth about 54,834 lakh outstanding. This was all just in Q1 FY26. So it really demonstrates pretty dynamic portfolio management. They're actively acquiring healthy loan assets to grow their book selectively. And importantly, the bank also confirmed two other compliance points. One, there were no deviations or variations in how they used funds they'd raised. And two, they're fully compliant with the security cover requirements for their listed debt securities, both important for investor confidence.
Okay, we've really dissected the performance now. So let's look at how they actually stack up against their own internal goals, their benchmarks. The bank's Q1 performance, when you compare it to their guidance for the full year FY 2025-26, it shows a bit of a mixed picture, doesn't it? So while they hit many of their targets and even beat some, there are still a few areas where they're, working to catch up to their own ambitious goals, particularly it seems on overall business growth and advances growth. But looking at this comparison gives you a really clear picture of their internal benchmarks and how they're measuring their own progress.
Yeah, this comparison is really valuable. I agree. Let's run through some specifics. They met or exceeded guidance for deposit growth. It came in at 11.41%, right within their 10-12% target range. Their RAM to corporate credit ratio was 72.28. That actually beat their target of 65.35, showing that stronger focus on RAM playing out. Net interest margin, NIM, was 3.16%, comfortably above their target of 3%. Provision coverage ratio, 97.02%, nicely within the 96-98% guidance range. Slippage ratio, which measures new bad loans, was 1.35%, meeting their target of 0.35%. Credit costs at 0.68% was well below their target ceiling of 1%. Return on assets at 1.02% met the goal of 1%. And the cost-to-income ratio at 55.43% was better than their target of 56%. So those are all pretty strong performances against their own internal metrics. However, as you pointed out, they did slightly miss on a few key growth targets. Overall business growth was 10.84%, whereas the guidance was 14.15%. Advances growth was 9.97% against guidance of 14.16%. Gross NPA came in at 3.13%, just slightly above their target of 3%. And net NPA was 0.49%, again, slightly above the ambitious target of 0.45%. Their CASA ratio at 46.88% was comfortably within the targeted range, which was 48% plus or minus 1%. So yeah, while some of those top-line growth targets are still a bit of a stretch based on Q1, the results definitely show strong underlying progress, especially on profitability and cleaning up the asset quality. And you'd expect the positive macro factors we talked about, plus their own strategic initiatives, particularly in digital and RAM, to continue supporting that growth trajectory going forward.
Okay, so after this pretty deep exploration, you should have a much clearer picture now of what's driving this major financial institution. But here's maybe a final thought for you to chew on as we wrap up. Given the bank's really strong focus now on growing that RAM business, retail, agriculture, MSME, and pushing hard on digital transformation, how might that combined strategy impact its overall risk profile? And maybe its competitive edge in what's a very rapidly evolving Indian banking sector over the next few years?
Yeah, that's a great question to ponder. And maybe add to that, how might the broader economic factors continue to play in? Things like the continued moderation we're seeing in inflation and maybe further accommodative policy changes from the RBI, like those repo rate cuts. How could those influence the bank's ability to actually meet those remaining growth targets and, crucially, sustain the profitability improvements they've shown? It's definitely a dynamic environment out there, and keeping an eye on those factors will be key to understanding their future performance.
Absolutely. We hope this deep dive gave you some valuable insights to reflect on. Maybe you want to dig deeper into some specific areas that caught your interest. Thank you for joining us for this analysis of the Central Bank of India's Q1 FY26 financial review.